Hey guys, so this is a video about basic investment considerations. These are a few things you need to know before you get started on any investing. So first, let's talk about the two terms risk and return and see how they're related. You need to know that all financial assets are risky. They're going to have some element of risk. Obviously, some are going to be more risky than others. We'll get specific later on. You need to understand that investors demand a higher rate of return to compensate for higher risk. Make sure that you understand that riskier assets offer higher returns to attract investors. You need to decide what level of risk you can tolerate. So let's consider a few investment objectives. In order to invest wisely, you need to review your own circumstances and make sure you understand what your personal investment goals are. A few things that will come into play when deciding how much and for how long you're going to invest are your age. If you're a lot younger, I would start as soon as I could, right out of high school, saving as little as $50 per month to get started, then upping that for every time you get a raise. Consider $100 within the next 1 to 2 years. And then, as long as you are investing regularly, you're going to be in the driver's seat later on in life. Since you're young, your willingness to take risks is much greater than those who are approaching retirement age. They need to be more conservative, not you. So you also need to decide what's your number, what's your retirement goal going to be. This is difficult because it's hard to predict exactly how much money you're going to need when you approach retirement age. Give it a shot. Think outside the box. What kind of lifestyle do you want to have? That will be your key to success later on after you decide it's time to retire. You have to keep things as simple as possible. You need to stay with what you know. If you can do that and you keep it very basic, you'll never have any confusion in your investment portfolio. It's always a great idea to focus on the fundamentals. Knowing a few fundamentals will create better choices for you down the road. People can build wealth with two different principles. They invest regularly. This means that money is automatically withdrawn from their checking account, for example, every single month. They don't even have to think about it. And then they watch their money grow. They also avoid investments that sound too good to be true, because guess what? They usually are. This simple chart describes the various types of savings instruments. So they're categorized into types ranging from a savings and checking account all the way to corporate bonds. So 3 terms you need to be aware of are liquidity, safety, and rate of return. When something's liquid, it means you can get your money on it extremely fast. A high rate of liquidity means you can get your money out anytime you want. Versus something that's low in liquidity, like a CD, where you lock your money in and you can't get it out. Think of safety as the opposite of risk. Something with a high degree of safety is going to be extremely safe to keep your money in, like a savings and checking account. It's always going to be there. Rate of return refers to the annual percentage rate. How much money are you going to get back on your investment? So make sure that you consult this chart and consider the different types of savings instruments. So here's a brief overview of the different types of savings products that are available. They range from the savings and checking account all the way through pension and mutual funds. So my recommendations are that if you want to go back and look at the rule of 30, for example, you're going to need a regular savings and a checking account. Everybody has to have one of those. It's essential. So the only difference between a savings and a checking account and a money market deposit account is that the minimum balance is much higher for a money market account. You might have to put down $5,000 or more just to have that ability. The trade-off, though, makes a lot of sense because you're going to get a much greater rate of return for that money market deposit account. Right now, the rates are really low, but when times are good, you might see an interest rate of around 2 to 3%, no problem. CDs, or certificates of deposit, allow you to lock your money in for a certain time period. Most CDs range in terms from 14 days all the way up to, I've seen, 7 years. The most common are about 6 to 12 months, at the end of which time you're allowed to decide whether you want your money to roll back over into an identical term or you're allowed to withdraw it. There is a penalty if you withdraw your money too early. It's a great place to keep your emergency fund. Now, corporate stocks are where investors have the ability to buy individual shares of stock, most commonly known as common stock. So, depending on the type of risk involved with that particular corporation, that will determine what the rate of return is. Remember, these can be risky investments, so be careful. With U.S. savings bonds, remember, these are like having a coupon that doesn't mature until 10 years down the road. So when you initially buy them, you buy them for, say, $25, and then 10 years from then, it's finally worth the $50 that's listed on the bond. These are the types of things that traditionally your grandparents might gift to you when you're younger, so that they're worth face value at the time they mature 10 years later. So similar to the U.S. savings bond are the government securities. These are treasury bills. Remember, they're bonds, which means it's an IOU. So someone like the government is borrowing money from you. They have to pay you interest every single month to make sure that they're holding up their end of the deal. With pension funds, understand that this is an opportunity for employees at a corporation, or even if they work for the government, to obtain the opportunity for future retirement funding based on their level of experience with the company. For example, if someone worked for Ford Motor Company for, say, 35 or 40 years, they would earn a portion of their particular salary back, and they would be paid that annually as an incentive for people to stay with that company. So my highest recommendation is for you to investigate mutual funds. This is a great opportunity for people who are like-minded investors to invest together. Think of it as a bucket of stocks where like-minded individuals stash their money and create huge amounts of buying power together so that they can buy individual stocks or bonds in order to create wealth together. And as you can see kind of behind my silhouette, the rate of return for mutual funds has the highest potential to make you a lot of money in your retirement package. So look for those as the best option possible. One thing you don't want to do is get yourself whole life insurance. It doesn't make a whole lot of sense. These life insurance reserve policies allow the insurance companies to make the bulk of the wealth that could potentially go to you. Instead, consider term life insurance and then renew that term life insurance after it expires. It's a much cheaper alternative, and you don't even need life insurance unless you have beneficiaries like children. It's for your kids. If you don't have kids and you're not married, don't worry about it. You don't need life insurance. Lastly, there's corporate bonds. Think of corporate bonds as an IOU from a corporation. They're stable, they make sense, and a lot of people use them in their investment portfolios. So why not you? So anyway, that's it. Hopefully you learned a little bit about some basic investment advice. Remember the pitfalls. Don't ever invest in something that sounds too good to be true. It usually is. Be smart, stick to the fundamentals, and invest regularly, and you will make your number come true. Don't count on